So let's talk a little bit about distributions. And you touched on this a little bit already, but so folks are clear in terms of, when it comes to 529 plan contributions, we talked about the tax-free growth, and you talked about the withdrawal of funds. There are certain parameters in place in order for the withdrawals to be tax-free. So can you talk a little bit about what are some of those parameters in place?
Yeah, so they're actually pretty generous with 529 plans. As long as your distributions are for qualified higher education expenses, they're tax-free. It also doesn't matter when over the course of the year you take those distributions. So you do not have to match your distribution to a payment. You just have to match total distributions to total qualified expenses. Qualified expenses, again, tuition, fees, room, board, books, required supplies, including computer and internet access. You can use it for off-campus room and board too, up to your college's off-campus living expenses. Now, some of these expenses you get very specific receipts for. So for example, a student living on campus will have documentation from the college of exactly how much was billed for tuition, fees, room, and board. Books are something extra, a computer is something extra. So you definitely want to be tracking those expenses as you go, keeping receipts. Audits around 529 distributions are fairly uncommon, but if they do happen, you absolutely want to be prepared for it. Off-campus room and board, like I said, you can use your 529 for that. Every college has a published cost of living for off-campus students. That's the maximum amount you can withdraw. Well, actually, the maximum amount is the lesser of how much you actually spent or how much your school's allowance is. So what happens if you take a non-qualified withdrawal? Meaning you took out more money than you have qualified expenses. If that's the case, you pay taxes and a 10% penalty on the growth portion of the distribution. The penalty, that 10% penalty, is waived if your excess is due to scholarships. So let's say you saved really aggressively and then your kid got a great financial aid package and you have to take more money out. You don't give up the you don't pay the 10% penalty as long as you're within the realm of what was covered by scholarships. And that's something that you should plan for if you discover freshman year that you're going to have a lot of excess. So, getting back to the earlier example of the 529 account, that's 50% contributions and 50% growth. Let's say you had $1,000 worth of non-qualified distributions from that account in a year. $500 of that would be growth and would be subject to the tax and the penalty. What I usually recommend to parents is that they have the distributions from the 529 go to the student, not to the parent. I know that's horrifying to think I'm going to send $10,000 or whatever the amount is out to my student. But if you ever have a non-qualified distribution, it's taxed to the person who received it. And chances are your student is in a lower tax bracket than you are. So it'll be quite a bit cheaper if that's the case.